Welcome everybody to our Payday Super webinar. I am Peter Revelas, a partner in the Business Advisory Division at RSM Australia, and I'll be hosting today's event. Before we begin, I would like to acknowledge the traditional owners of the land and waterways on which we gather today and pay our respects to elders past, present and emerging. Today we are joined by two of RSM Australia's leading advisors, Alicia Bailey, a director in our Business Advisory team, and Gina Nedelkovic, a director in our Global Employer Services team, to help us unpack the upcoming changes to employer superannuation obligations, what they mean for your business, and how to prepare for it. Throughout the webinar, we'll cover changes coming our way, the ATO's approach, some practical guidance for employers to get ready, and some real-world insights. Throughout the webinar, please feel free to use the Q&A or chat function to log any queries you might have. Although we won't address them live, we will come back to them and address them at the end. So before we get started, we'll run a quick poll before we get into the webinar to see how many employers are currently paying superannuation contributions frequently. So please take a second to answer the poll and give us an idea. Might give that another 10 or so seconds and then we can share some results. Right, so monthly seems to be the overarching, the general, although due date is the one closely following. Interestingly, the ATOs recently said in a seminar that they believe 40% of their employers are lodging and paying superannuation on each payday already. So this shouldn't, in their eyes, shouldn't come as much of a surprise or a change to many people's or many employers' current processes, but we'll jump straight into it then and deal with the detail a little bit more with Gina and Alicia. So, Gina, I might start with you. Starting us off, could you summarize the most significant changes that Payday Super introduces for employers and why these changes are happening now?
Thanks, Peter. I'm first off going to start by saying that there are a lot of changes that we will be covering, and we will be sharing a copy of our Payday Super update, which some of you may have seen previously. We will run through a lot of that in today's content today. So what is changing? Payday Super has definitely been one of those hotly anticipated changes that has been a long time coming since it was originally announced. The key change is Payday Super is requiring employers to pay super guarantee contributions in each pay cycle rather than the current quarterly requirement, which is a massive change, particularly for smaller employers. Unlike the rolling integration that we saw for single touch payroll where smaller employers were delayed, these measures will kick off for everyone from 1 July 2026. And these measures form part of the government's central strategy around addressing non-compliance of super, which they've currently estimated is a staggering $5.6 billion a year. In one of the parliamentary sittings last month, Treasurer Jim Chalmers highlighted that while most employers do the right thing, there are some disreputable employers that are what they say are exploiting their employees, and he emphasised around how unpaid super contributions are a form of wage theft. So we're really seeing through these changes that the government is really keen to put a stop to this position. So some of the changes are more generous than what we were initially anticipating from some of the earlier draft legislation proposed. So we saw a move from 7 business days from 7 calendar days. And thankfully, following the extensive public submissions that we saw, these requirements were updated to align with something a little bit more palatable or realistic. But no doubt we will see employers facing some challenges, particularly in the initial transition phases. So probably now until the end of the first year at least. So let's do a bit of a deeper dive on the changes. With most legislation, we can expect to see some exceptions to the rule, and Payday Super is really no different. There is some relief to employers where new employees join during a pay cycle and where employees are changing funds during employment as well. In these cases, there will be an extension of time to 20 business days. The concept of payments must be received within 7 business days means that contributions must be received and able to be allocated within 7 business days. So this was explained in the explanatory memorandum to mean that the super data must be complete, it must be accurate, and it must be paid. Now, the "and paid" bit even trips employers up now because the payment needs to be made to the employee's fund, not just to the clearinghouse. So that's a big one to remember. Not only do we have the key change being the payment date, but there are a number of other components which change the underlying calculations. The law impacts entitlements too, with the superable earnings base now being called qualifying earnings. So another acronym that everyone will probably need to learn, which, as you can see from the slide in front of you, it remains largely unchanged from the concept of ordinary time earnings or OTE. But we see commissions are now specifically called out as qualifying earnings, and this is regardless of whether there is an overtime element to the payment or not, which is a different position from our current state. Additionally, we are also seeing components or earnings which previously resided elsewhere in the Super Guarantee Act. So, for example, we've listed the contractor payments, which are considered superable, or where they're considered superable, I should say, and directors' fees being defined now as qualifying earnings. And just to note, with Payday Super, there is no obligation to report through single touch payroll for your contractors. You can if you want, but this is not a legislative change on this front. One of the key changes which will spark a lot of interest from employees is the change to the maximum contribution base, or MCB, which we will now see move from a quarterly cap to a rolling annual cap. Employees will need to receive 12% of qualifying earnings up to the cap each year, so not each quarter as it's currently calculated. There is a new ordering concept rule. So if for a qualifying earnings day, which is essentially the payday, if you have a shortfall on that day, the next set of contributions paid for that employee will be brought back to apply for the qualifying earnings day that had the shortfall. So, for example, contributions which were calculated for qualifying earnings 2 will be brought back to apply for qualifying earnings 1, which is a bit of a change for employers to get their head around. Now, a lot of employers listening now will be wondering, well, what about if we get it wrong? And similar to the current state, an employer can voluntarily disclose and have a super guarantee charge assessment, or have this assessment by the ATO from its own initiative. So if it's ATO driven, this will affect the way in which the super guarantee charge is calculated. And as you can expect, it's unfavourable for an employer in that position. And finally, we have the update to the way in which super stream reporting will operate, with the new payments platform being put in place. The introduction of this platform is ultimately to speed up the timing of making payments. So, some of you who may currently use online banking personally, if you've ever seen OSCO referenced in any of the payments that you've made, you're currently using the new payments platform. So lots of changes, Peter, for employers to get their head around. So I might just pause it there, and pass back to you for any additional questions that you have on that.
Thanks, Gina. The I guess so what are the critical compliance risks then for businesses under the new regime, and what practical steps should employers take now to prepare for the 1 July 2026 start date?
Yeah, great question. And look, this is the most substantial change in superannuation in the last 30 years, which is quite exciting for us in the world of tax. But I'm sure there's a lot of people that are listening today that are cautious of these changes and also quite nervous about what it means for them. From my perspective, some of the critical risks I think employers should focus on are understanding what makes up the qualifying earnings and working with your payroll software provider to implement the required changes for reporting. In the current state, I've seen so many employers not understanding the concept of ordinary time earnings, and I suspect qualifying earnings won't be any different. So I'd probably recommend getting a full review of how your data is being configured to calculate qualifying earnings. And this will be important as well, Peter, because it'll feed through to your single touch payroll reporting too, which is not dissimilar to the current state. But it's important to note that an employer may have differing obligations too between the super guarantee requirements and those which are governed by either an award or a contract. So definitely thinking about some of those things too. The ATO have said that they will continue to use single touch payroll data to match against information and work out if there are any shortfalls. So again, no changes from that respect. I think the calculation of the MCB is going to cause some headaches, particularly because we already see it causing some challenges around the quarterly cap. So expecting a rolling balance will likely bring some further challenges for employers. So we probably need to see from a system perspective, the MCB calculation will need to be calculated per qualifying earnings period. And then obviously any processes that you have in place to do your checks and balances. And broadly speaking, it'll be critical for employers as well to be able to have a process in place for detection of any errors in the calculation. And maybe that is something that needs to be considered outside of the payroll system as well. Obviously, understanding the super stream changes, we will see a requirement for funds to allocate or return contributions that can't be allocated to 3 business days. So it'll be important to update those processes to ensure that the rectification can be done as soon as possible. Also understanding, the calculation when you get it wrong and what processes you need to follow, not only for any ATO notification, but also internally as well, because it's going to be quite time sensitive moving forward, which I'm sure we'll talk about in detail as part of the webinar. Any out of cycle payments, which are very common for employers. So keep an eye out on ATO communication, as the legislation does give the Commissioner the ability to decide what kind of payments are out of cycle via the creation of legislative instruments. So we'll probably see some more of those published by the ATO around Payday Super. The ATO have said at a minimum, out of cycle payments will include commissions and back payments. And employers will then have until the end of the next qualifying period to make that contribution. Alicia, what about your thoughts on that?
Look, I think, Jenny, you've covered it really thoroughly. I think just to look at it at a practical standpoint for most employers is really just to research and understand the applicable legislation changes to you. I think you've all done the right step of attending this webinar, so you're a step ahead already. I think thereafter, I would say it comes down to planning, implementation, and thereafter monitoring. So step one, tick, done. Step two is really running through the legislation, understanding how that applies, looking at your processes and systems, and testing and planning well before the 1 July date. And then come the 1 July date, it's not just a set and forget. There are still some risks associated to are the systems running right? Are there bounce backs? It's continuously monitoring the outcomes and managing any bounce backs or late payments. So just from a high level, I think just as much planning as possible pre 1 July. Don't leave it too late. No one wants to leave payroll changes till the 1st of July. Over to you, Peter, just on the next question.
Thanks, Alicia. I might just remind everybody that we are recording the session and we will be sending out a link to the session as well as slides. So thank you for some of those questions that have come through, but just reminding everybody that we will be getting those out to everyone at the post-completion. Alicia, just quickly on that comment you just made there, is it okay to wait? Is it okay to start early, or do you have to wait until the 1st of July to begin?
You can start. Yeah, great. Oh, sorry, Peter. Great question. You can start now. As soon as the draft legislation came in, I ended up starting discussions with much of my clients earlier to opt in and start paying. We obviously didn't know the intricacies of what we need to be aware of, but the sooner you opt in and the sooner you get used to the transition, it's a much smoother transition 1 July rather than rushing and waiting and mitigating that risk of not being compliant.
Right. All right. Alicia, so how should businesses approach updating their payroll systems and internal controls to ensure that they are ready for more frequent superannuation payments? And what are the practical challenges you foresee?
Thanks, Peter. I always think it comes down to process changes, people, processes, and systems. So from a people approach, I think what organizations need to do, or owners or directors, is need to make sure that the appropriate people are aware of these changes. So that doesn't necessarily impact just the payroll team. It's down to the employees, HR, in the extended stakeholders, and we'll cover that a little bit more later. But I think communications is the first point in relation to this change and the appropriate people. I think it's a great opportunity now to delve in deep and understand a review of your payroll processes and systems. I think one of the biggest challenges that most business owners have, or payroll people have as well, is obtaining the right information on time for a payroll. It's really critical timing. It's very timely. It's a struggle to get everything on time to process that payroll. So there are some ways that we can look to streamline that process through automations and systems. I'm not sure how many businesses are still aware that there are options out there that allow the employee to be put in the position to apply for all of their information before a pay run. It's called self-employee onboarding. So there are solutions out there that will send a link out to any new employees before they start and allow them to prepare all of their paperwork before they start. There's a benefit to the business there that they're not sitting there in the first day filling out a TFN form and a super choice form. But the other benefits associated to that is the payroll or HR teams at the moment aren't sitting there and manually transitioning data from a form into a payroll solution and then getting one single number wrong. And that then results in, particularly on point, is super bounce backs or not paid on time. So I think there's a challenge there, but there's an opportunity to review systems, particularly in that onboarding phase, and that will mitigate any risk associated to late payments for super. I think there's a few more high-level things I'll run through as well in terms of processes to run through. I mentioned it before in relation to cut-off timing. I think a payroll will run super efficiently if you've bedded down your payroll processes. If you're aware of all the payroll information that needs to come in on time, a strict cut-off, say 2 or 4 days prior to the pay run that needs to be processed, and then a strict cutoff to say that no more changes will be applied thereafter. And then that'll allow the payroll team sufficient time to process the payroll, have it reviewed and approved, and feel confident in the numbers that they've done and everything's been calculated in line with legislation. I would recommend reviewing the qualification of QE earnings that we mentioned before in your STP setup. It's a good opportunity now. It's been around since 2019. However, a review of this will be beneficial to ensure your compliancy. System updates, we talked about maximum contributions before. We might already have that set up in your payroll solution to cap it quarterly. Those will need to be reviewed across your employees and updated if the system automatically doesn't do that for you. Review of agreements in relation to applicable clearinghouses. We might cover that a little bit more in relation to going through the change in the decommissioning of the super clearinghouse, but I think it's important knowing the clearinghouse process and the days of time it takes to actually clear the employee fund and reach the employee fund. Reverse that round. So we would need to make sure that from compliancy standpoint, it's reaching the employee's bank account on time. Some people may not be aware that some of the clearinghouses that you're using at this time can take up to 5 days. So when you think about 7 business days to pay super on time, that 5 days doesn't leave you much time. So a recommendation with there would be not to reframe and pay super a couple of days after your pay run, is to streamline and play that all at once and just give yourself a little bit of a save on heartbeats there. I think, as I mentioned before, test all the new processes well before 1 July. You want to test out any teething issues and any risks associated to any reconfigurations or whatnot well before 1 July. Refine and give yourself and the payroll team that confidence that the transition and compliance will be done well in time. And another recommendation I would seek to employers, and it might be an uncomfortable one, it can be, is considering whether are you doing your payroll frequency too frequent. I know it's not a comfortable conversation to have with some employees that we might be moving away from weekly to go to monthly. But if you were to consider that with all the risks associated in the increase in compliancy, it definitely is going to reduce the administrative burden on your business and your finance team to managing more frequently. I do need to know, obviously, you need to ensure that there is an ability to do that with your award. So obviously check out with your advisors and ensure that's a requirement, but it could mitigate a lot of burden to your internal team in the longer run. So that's a few answers there. That was chunky enough to give everyone a bit of a couple of practical guidance, but I'll pass back to you, Peter.
Thank you. Gina, so the ATO has outlined a risk-based approach for the first year. How will employers know if they are considered low risk, and what are the implications if they are not?
Yeah, great question, Peter. Look, there's some concern that employers won't have sufficient time to deploy, test, and embed the changes prior to 1 July. And obviously we expect to see an increase of risks for employers on being compliant. Even the ATO was concerned with the proposed start date, and you can see that their proposed compliance approach for the first year is trying to recognise that employers who do try to do the right thing and resolve issues quickly will not be the focus of ATO compliance action. The first year is really being considered as a grace period by the ATO. We can see that the ATO has done a traffic light system approach on investigations of non-compliance of super. If an employer is low risk, then the ATO won't have cause to review. Obviously, the highest priority will be given to higher risk employers. The ATO only has the scope to decide where they will apply their resources, and this is ultimately what their guidance is giving us. So let's understand what each of those ratings mean. So low risk employers, obviously ones that are making contributions on time equal to or exceeding the individual super guarantee amount, even where paid late, if they're paid as soon as reasonably practical, and those amounts don't create a shortfall other than being late, they will be considered low risk. So falling within the green zone doesn't mean the employer will not have the liability for the SG charge. It just means that the ATO won't allocate compliance resources to investigate those in the green zone within the first year. Looking at medium risk, if they're paying the right amount within 28 days following the quarter in which the qualifying earnings were paid, they may fall under medium risk. So this will essentially be those employers who make sufficient contributions but do not change the frequency of those contributions in line with Payday Super requirements. So essentially operating in kind of current state model. Higher risk where the contributions are not correct, so the shortfall is not nil and they're paying after the 28 days. So the ATO have said that the approach is tailored and focused on risks and patterns of behaviour, and trying to curb the patterns of behaviour that are creating the shortfalls. And they've said that they're not out to play gotcha and find every late payment, but really want to address the patterns of behaviour. And I think it's important to reiterate as well that the ATO cannot disregard the law. So they must assess the SG charge if they obtain information that an employer has a shortfall in respect of a qualifying earning day, even if they are in the green zone, which is the same as the current state. If an employee complains, for example, they have to investigate. I will say the concept of reasonably practicable does give me some concern, as it is the ATO's discretion. The ATO even said if there was meant to be a time limit on it, it would have been written into the legislation, which didn't really give me much comfort. There could also be some situations where the employer moves between the zones during the period. So it will be important upfront that employers use this time now to properly configure, test, and get their processes sorted so that they can remain consistently in the green zone and try and limit the confusion as much as possible. Whilst the practice compliance guideline is useful, we do find it limited in some of the content. So one of the key areas that I see is really addressing situations where contributions are late to delays or factors that are completely out of the control of the employer. And this has been a common issue for employers, even in the current state. But we know there is a reluctance for the ATO to put pen to paper on these sorts of issues that is not entirely to the letter of the law, particularly when it comes to superannuation. And unfortunately, the letter of the law does say that the employer is liable, and there's no grey area for getting it wrong or even providing a bit of protection when it's outside of an employer's control. The Commissioner does have the power to make determinations of exceptional circumstances to the extent to extend the requirement to 20 business days, but it really does sound like it's quite limited because one of the references that was given was natural disasters, and even then 20 business days may not be suitable. And lastly, an employee is still within their legal right to make an ATO complaint if they feel they're not being paid the right amount of super. And often where we see these complaints being made is after the employee doesn't feel like they're being heard or any actions being raised. So we do recommend that you consider and look into employee complaints quickly and really keep that line of communication open as well, particularly where you're seeking additional advice, because like any law, things are often unclear and require additional interpretation. So, Peter, I'd say to those listening, the key will be to really knuckle down on that process to help alleviate the possibility of it being taken unnecessarily further.
Right, thank you, Gina. Back to you, Alicia. So with the ATO Small Business Superannuation Clearinghouse being decommissioned, what should businesses look for in an alternative clearinghouse? And who is ultimately liable if super isn't paid on time?
Thanks, Peter. I may have referred to it before, or most of you may already be aware, but a lot of payroll solutions at the moment have an inbuilt clearinghouse. That would be my first recommendation. Utilizing an inbuilt clearinghouse just allows for accuracy and efficiency with making the payments. For those that aren't aware, it will automatically debit your bank account with some systems and then push exactly the superable components directly through the clearinghouse to the employee super fund. So it's the most efficient and effective approach, I believe. there are alternatives in terms of having a standalone clearinghouse, whether it be through your default super fund, or I believe Australian Super refer to a free use of Quick Super as a clearinghouse. I understand this is an option, but there still would be a manual element there, and it's still a viable solution. I think in terms of adding to that, I would say making sure that you're choosing a reputable either payroll solution or firm, payroll solution or clearinghouse, ensuring that you're not sort of cheaping it and looking at the cheapest solution available. Essentially, this is a high risk area. So take your time, do your due diligence before 1st of July and ensure that you're partnering with the right provider. I think there is worth noting that essentially the employer is liable for late payments. There isn't much wriggle room. We spoke to natural disasters there at 20 days businesses. They're not allowing much flexibility there. I think there is worth noting, though, in terms of any late payments where you are using a clearinghouse, I think it is very much worth reviewing your contract with that clearinghouse to see any stipulation if there is an error at the clearinghouse due to a delayed payment, and seeing if there's an opportunity not to claim back any of the super payments per se, but obviously it would have been in relation to any penalties or interest associated with that. I very much recommend looking through those contracts before you delve into working with a clearinghouse for that. And then any additional costs that they also may have associated to using their clearinghouse is also worth investigating before you make the move. That's pretty much everything I have on that, but I'll pass back to you, Peter.
So just a quick question on that then, Alicia. How will employers know if the contributions paid to super funds have actually been received or not then?
There's an option to look on your ATO clearinghouse and see that have been cleared.
Great. Perfect. Okay. So Gina, how will the shift from quarterly to annual maximum contribution-based calculations affect payroll processes, and what reporting changes should businesses expect?
Yeah, so obviously the way in which the system calculates the MCB will need to be updated, which is a big change. That will obviously need to be tested. Once an employee's qualifying earnings exceed the MCB in the financial year, any subsequent qualifying earnings for that employee are disregarded in calculating any shortfall amount. So essentially, it just means that you've met your minimum requirements for the year. There is still the employer shortfall exemption certificate rules, which have been modified to allow for employees to obtain a certificate if they have more than one employer for the financial year, either consecutively or concurrently. So that will be a process or a documentation change. If the certificate is in force, the employee is then treated as having met the MCB. The employee can provide the certificate to the employer, who won't be liable for the charge if they don't pay SG for part of the employee's qualifying earnings above the MCB. The interaction between current state and Payday Super is always also going to cause some headaches in the first year for employees, particularly if they are salary sacrificing and maximizing the reduced taxes available for concessional contributions. Because if you think about the first year, in particular the month of July 2026, Q4 2025 contributions are also going to be counting towards the FY 26-27 cap. So employees and employers need to be aware of this. So there will be a bit of perhaps a documentation change internally around what that means, because there might need to be an update in terms of information collected from employees around the amounts, just to make sure that they're not exceeding the caps and being taxed at higher rates. There will also be some practical considerations for employers around the way which employees' remuneration packages are set. So, whether it's inclusive or exclusive of super. And there may be scope to have that salary component looked at if there is no super obligation for any remaining part of the year because the MCB has been reached. So, what does the documentation to the employees actually look like? There isn't any changes, unfortunately, to superannuation around foreign employers, so they will need to continue to have an obligation where they have individuals working in Australia, and the obligation to pay will be within the same timeframes that I'd mentioned to you earlier, Peter.
Thanks, Gina. And just with foreign employers, what happens if there's no Australian bank account for someone who is eligible for superannuation payments? What do they do then?
Yeah, unfortunately, there's no mechanism in the law to offset that. The individual will need to set up an Australian superannuation fund. Otherwise, the employer is not compliant in that sense. There is still some exclusion. So, for example, if an individual is a prescribed employee, so your senior executives coming across to Australia on temporary visas, they may be excluded from superannuation, or if we have a bilateral social security agreement with that country and there's a certificate of coverage obtained in the foreign country, then perhaps that will alleviate the superannuation. But unfortunately, if those exclusions don't apply, an employer will be non-compliant.
Great.
And just to add to that, there are some practical solutions around looking at virtual bank accounts. There's many solutions out there, both from employee or employer perspective, where a virtual bank account can be set up quite efficiently in any country and converted to different currencies. So that might be a workaround solution for some organizations as well.
Perfect. Thanks, Alicia. Back to you. So what are the pros and cons of moving from quarterly to per pay cycle super payments from a cash flow and forecasting perspective?
Thanks, Peter. I'm pretty passionate about the fact that I think this is going to help a lot of businesses manage cash flow. I think it's going to smooth out um, cash flow for quarters ahead. I think in the past, what we've seen is quite difficult. A lot of small businesses finding difficulties getting to that quarter end where we've got a quite significant super obligation outflow together with GST at the same time, which has created quite a lumpy and chunky cash flow to manage year on year, quarter on quarter. So I think with the introduction of same day, it's going to be a lot easier to manage that cash flow, but also forecast that cash flow. Even forecasting, I love forecasting. It's always been a pain for me, is factoring in how much cash that we need to manage for those quarters for a lot of the small businesses, and sometimes getting to a tight period where we're cutting it close with our cash flow. It also reduces the risk of compliance. So from a compliance standpoint, sort of leaving it back to cash flow, doing it more frequently, what we're going to see is every quarter, or reversing it from previously every quarter. If a super payment was missed, that's quite a significant obligation to have to pay interest charges and penalties on. So we went from previously, say 60,000 super per quarter, was missed a day late, that was penalized straight away and interest charges on that. Whereas with the new Payday Super, we're closing that gap a little bit, well, I would say a lot actually, and saying roughly about $20,000 per month is paid on time. If we are a little bit late, it's a less of an impact on the business and the cash outflow expected on those penalties. Similarly, just I think from a reconciliation point of reconciling the super and actually catching those late payments moving forward is going to be really beneficial for businesses. Whereas if you got to the end of the quarter and you missed a couple of payments or you didn't have an employee super fund details, it was a mad scramble because you knew you had a quarter's worth of payments to pay on time and then pay the penalties associated with that. On the other side, I do think the introduction is creating a high administrative burden on a lot of businesses. particularly those that have quite a strict cash flow management policy or require multiple people involved to process a pay run and approve. It's only adding another layer to manage that more frequently and get that processed in time and employees paid on time. Equally for small businesses where I do see it's been beneficial that it has smooth cash flow out, there are some businesses that heavily rely on that quarterly buffer to maintain that cash flow within the business for working capital for various reasons. Or even say a seasonality impact where the business kind of waits to that quarter if they have a higher trading time and they have the cash available to pay that super. So there is a converse reaction to what I mentioned before around smoothing that. Additionally, from a cash flow impact, I think there is a negative that there could be additional costs associated with managing these changes, be it through systems, processes, additional clearinghouses. So an added cost to the business, ultimately resulting in more outflows of the business. And I think I mentioned before as well, just the cutoff and having to maintain a buffer in time to pay all these obligations in such a short turnaround time is what I'm seeing and what are my thoughts around that. Thanks, Peter. Back to you.
So given the late payment offsets will no longer be available, what are the consequences for late super payments under the new rules, Gina? And how can businesses mitigate these risks?
Yeah, thanks, Peter. I'm going to refer to some slides on this one as it's a little bit complex, and I might talk generally around what it means if you get it wrong in the land of Payday Super now. So just to reiterate some of my comments from earlier, where you have paid late, contributions you made for later qualifying earning periods now can be brought forward. And if you do get it wrong, the super guarantee charge can be assessed either via a voluntary disclosure or an ATO-driven initiative like an audit. So again, not too dissimilar to current state environment that we're in. The shortfall will be calculated on qualifying earnings. So now there's no need to do the uplift for salary and wages as we do in the current state, which is probably a welcome change by many. There will be a base shortfall which will crystallize at the 7-day mark, and then a final shortfall which will be based on contributions that are applied post 7-day mark, so a little bit to get your head around. Any contributions made late and prior to an assessment being made do reduce the final overall shortfall. However, there isn't a late payment offset anymore, as the law is actually now reflecting the order in which the contributions are applied, being that contribution will be allocated to the earlier qualifying period. So bringing in that ordering rule that I mentioned earlier. We have some new concepts being the individual notional earnings, which is essentially the interest component that we're used to, and an administrative uplift, which can be up to 60% of the shortfall and the individual notional earnings. The 60% may be scaled depending on some factors, including ATO-driven initiative assessments. The intention of the uplift is to encourage that compliance that I mentioned before that the government is hoping to achieve and drive voluntary disclosures, and also recognizing the past history of compliance of the employer. So you really want to be recognizing those shortfalls and actioning them quickly, as it can affect your uplift going forward. The notional earnings, or the interest component, is now going to be charged at a compounding daily rate. The SG charge itself will move from non-deductible to deductible itself, which is great news. As mentioned in the explanatory memorandum, I believe, it's to reflect that the SG charge is at its core a fiscal incentives for employees to recognise services rendered, and it aligns to other payments made to employees like salary and wages, which have the character of deductible expenditure too. Interest or late payment penalties won't be tax deductible, though, so you will need to do that adjustment through your income tax return. There are additional interest and penalties that can be applied. So if the SG charge remains unpaid 28 days after the assessment, the ATO will issue a notice, then a late payment penalty will apply. There is no power anymore for the ATO to remit the penalty, either in part or full. However, GIC or general interest charge won't accrue on the penalty. So it'd be really important to ensure that you are actioning those assessments quickly, as you can see that these charges can quickly have a higher monetary impact than the current state. And as I mentioned earlier, if the employer opts to voluntarily disclose, this may reduce the admin uplift. So again, ensuring that you have those mechanisms in place to detect non-compliance going forward, so that you can still have that ability to be able to remain in that voluntary disclosure territory will be important. And lastly, the final step in any non-compliance will be the commissioner obviously making the assessment, and they will use the information that's available to them either through the voluntary disclosure or their own initiative, Peter.
Thank you, Gina. Now, I am conscious of time, and we do have a couple more questions to get to, and I do want to provide the audience the opportunity to get some questions answered as well. So, Alicia, very quickly, or at least briefly, what should businesses be doing now to educate their payroll teams and communicate these changes to employees?
I'll cover a little bit here just at the front end. I think what we need to be aware of that all internal stakeholders, there's many internal stakeholders that this is going to impact. From my perspective, it's really making sure that the HR team and the payroll team are working together to understand the changes and the information required to maintain compliancy. And then overall, the employees need to be communicated with the changes. I think it's beneficial of an organisation to be transparent with remaining compliant and being compliant in time, and just letting them know the changes that will impact, just in case any questions arise. But I might pass over to Gina. I think she's got a couple of other internal stakeholder thoughts in mind as well.
Yeah, my comments are really depending on business size as well. So one that I thought of was IT. Obviously, the payroll system will need to be updated, and IT may be involved in ensuring that this runs, fit for purpose. And they could be assisting as well with doing any parallel testing environment scenarios. Your finance and treasury team as well, because they will need to understand the process of releasing funds and any approvals on that front, and perhaps the executive board as well, with maybe some linkage or decisions made on timing of paying employees. Obviously, if your award or agreement allows this, will need to be considered as well. And perhaps some decisions around bonus payments and timing may need to be considered on that front too. And obviously there may be some external stakeholders. So, IT, there will also be the overlap with your payroll providers and clearing houses as well to consider, which Alicia ran through earlier.
Right. So, Alicia, from your perspective, what are the biggest advantages and disadvantages of Payday Super for the Australian businesses?
I think I was pretty vocal about the cash flow management. That's a positive side for me. I think for small businesses, smoothing out the cash flow and mitigating that struggle that previously was had by a lot of small businesses at that quarterly spike period for cash outflows. And in terms of from a disadvantage, I think for employers at any size, larger corporates or SMEs or just a one-man band, I think there's been quite a significant amount of changes in the payroll landscape over the last five or so years, with single touch payroll phase 1, phase 2, super changes from up 0.5% every year. Particularly mitigating that the contract has been stipulated right and you've applied the super percentage right. Through to this current change, I think it's a bit of a disadvantage for businesses having to sort of drop what they're doing in their day-to-day business, running the business, and focus on this critical element to remain compliant. Gina, I'll pass over to you. Did you have any thoughts as well?
Yeah, I think I'm going to start off with the negative first, and then round out with the good news. I think from my perspective, one of the cons is obviously the time frame. Really use that lead up time wisely. Don't be thinking, oh, I've got 7 months to go. I've got plenty of time. Really take on board Alicia's practical tips and tricks that she mentioned earlier, and really use this time now to as a test or practice period. And just quickly on the pros, I think the tax deductibility and obviously not having the uplift for salary and wages now is a win. It was always confusing for employers whenever I would say, okay, you've got a shortfall. Now we need to do this other calculation to work out what this additional shortfall is on salary and wages. So from my perspective, it's a win. And I also think it's a win for employees. I know that we've focused a lot on employers. I think it's a win for employees because they're going to be getting their money a lot sooner into their super funds from an investment perspective, Peter.
Great. Thank you, Gina. So that rounds out the question, or at least the panelists' questions. I think we might just run another poll quickly. What is your biggest concern around Payday Super? So if you could just type in an answer there in as many or as few words as possible, that highlights your concern, that would be great. And we'll give that a little bit of time, and then we'll jump onto some Q&A that has come through onto through the question or the chat. So I'm sure, and I believe that the responses should come up in a bubble, sort of give everybody an idea of what everyone else is feeling with respect to Payday Super. And there have been quite a few questions around how this is actually going to work practically. So I hope that a lot of the information that Alicia and Gina have managed to get across today has answered many of those questions already. So all right, just wondering if we get a response.
I think we might be having an issue with the
It looks
response
like
to the poll, but we can
something's
share
gone wrong with
share
that
this
poll.
after.
Well,
Technology.
unfortunately, that was not going to work. So, all right, what we'll do is we'll jump onto the Q&A while the team try and sort that one out if possible. So just a quick question, and Alicia or Gina, I think, Gina, you spoke about qualified earnings earlier and how that is now the new definition, as opposed to previously being ordinary time earnings. Can you, just with respect to how that definition has changed, if at all, or is it just a new term that they would like to use for various reasons? But things that previously would have been ordinary time earnings, do they continue to be qualified earnings? And are there any additions or omissions from the original definition? I think we've had quite a few questions on that.
Yeah, so the qualifying earnings, part of it is still ordinary time earnings. So there is that concept of what was previously ordinary time earnings, still being part of qualifying earnings. One difference to probably bring out is that concept that I mentioned earlier around commissions. So commission payments, even where, and look, I haven't really seen it being that common, Peter, in practice, where the commission was paid because of overtime, that now is still being considered qualifying earnings, where previously it wasn't actually considered ordinary time earnings. So I think that's probably the biggest change, but it is largely very similar.
Right, and that's good news. So I think previously, I think for most people who are asking if there are any changes, for example, to payments that previously did or did not attract superannuation, they can pretty much be safe to say that it would continue the same. It would only be very limited circumstances where that would change, and that's probably something that would be at least easily identified.
Yes.
Great. there is a question here that says there are some clients that they have who are more like set and forget, and they pay their quarterly superannuation payments on time every time, and it's the same and no real changes. Now, what has been asked is can they pay their superannuation up front for the year entirely, so 12 months in advance, and then make adjustments along the year for anything that may adjust that, such as bonuses or commissions, for example, stuff like that. Who would like to take that one?
Alicia, do you want to answer that one?
Yeah, look, that's a difficult question. The way I've always seen it is essentially what the ATO is trying to move towards is tracing payments in time with payroll. So my thoughts would be the best approach is to continue to pay it on time as the payroll's done to allow the ATO to reconcile. It's essentially what they're doing is data matching everything. I think where there's not going to be a data match being front payment of super, it may trigger a review. The review might be clear because it's an upfront payment. However, it's just unnecessary burden potentially. So I hope that provided a bit of an answer to that scenario.
Right. All right. Move on to the next one then. For those with contractor payments, now obviously same day or payday super applies with employees. When it comes to the contractor, when is superannuation paid? Is it paid on the day the invoice is paid, or is it something that is done differently for some other reason?
Yeah, so it will be in relation to when the invoice is actually paid and when it falls within the qualifying earnings period, Peter, and it will follow the same time frame that I was mentioning earlier around the 7 business days following that that pay cycle.
Right. Now, I am conscious of time and we have run out of time. Unfortunately, there are still 30 open questions here, unfortunately. So I don't think we'll get to all of them. And I'm quite sure the more you talk, Gina and Alicia, given you have been so knowledgeable on all of this, it will just generate more questions. So what I might suggest is what we'll do is we'll download those questions and we'll try and respond to them. You will get a recording of today's presentation, and with that will come a link to our Payday Super Insights document as well. So if there's anything that, any burning questions you may have, that might be your first point of reference. And if not, please feel free to contact either Alicia or Gina. I'm sure their details will be shared. And with a bit of luck, we'll be able to assist you. So I think that is all for today. So from Alicia, Gina, and myself, we wish you an enjoyable rest of your day. Thank you very much for joining us.
Thanks, Peter. Thanks, Gina. Thanks, everyone.
Thanks, Alicia. Thanks, Peter. Have a good day, everyone.